Menu. Login. Arbitrage trading for different types of investors. The use of arbitrage trading directly depends on the size of the investments that you're ready to make. We often encounter clients who want to first test a trading strategy with small amounts of money before committing larger sums. Often traders and investors are different individuals. The trader needs to convince the investor, which requires good trading results. When the trader does not have sufficient funds, he is forced to try to achieve good trading results by using small amounts of money. This approach is understandable, but it doesn't make it a good approach. Managing $1,000 is not the same thing as managing $100,000. The technology, money management tools, and brokers that are used will be very different in these two cases. The methodology used with $1,000 will be nothing like the methodology used with $100,000. Let's look at some of the methods available to different kinds of investors. I am going to break them down into different levels, but this is not an exact science. If you're planning on investing $10,000, you can do as well with the method recommended to investors who have $100,000 to $8,000 as with the method recommended to investors who have $8,000 to $50,000. But this will still serve as a good point of reference. When you have several $1 million to invest, I recommend opening a Prime account with a company such as Abnamro.com. Once you create your own liquidity pool based on the PrimeXM bridge, you can use multi-leg arbitrage with the help of our multi-leg VIP arbitrage software, comparing prices between different providers. At the same time, you can sell liquidity to brokers. Investors with $30,000 to $50,000 might do well with two fixed API accounts used in conjunction with our hedge arbitrage software. The accounts should be with brokers who have their servers in the same data center, but with different liquidity providers. Many clients often confuse liquidity providers with technology providers. PrimeXM or 10 are technology providers that will help you connect to a liquidity provider, such as Invast or CFH via fixed API. In other words, you can have a PrimeXM fixed API connection for two different brokers and use our hedge arbitrage software, but the technology providers can be different. If you have $10,000 to $30,000 to invest, I recommend having two fixed API accounts and locking arbitrage, and or one fixed API account and two fixed API accounts or one MT4 account and hedge arbitrage. Both applications will work well. When using lock arbitrage, it is desirable to use FOK orders in order to control slippage. If the broker does not support FOK orders, i.e., if they are not built into the protocol, you can also use market orders for the purpose, since slippage with fixed API will still be lower than with MT4. Do not use IOC orders as they might lead to incomplete fills, which can cause imbalances between your locks and, consequently, cause losses. When using hedge arbitrage with two fixed API accounts, we also recommend the use of FOK orders. If you know which of the two brokers is the faster one, you can try enabling the open on slow first functionality. In that case, the application will not open orders with the faster broker until they're opened with the slower one. In that case, you can avoid a situation where an order fails to open with the slower broker for some reason, and an order is closed with the faster broker with a loss. For investors with $1,000 to $10,000, it is best to use locking software with two fixed API or two MT4 brokers. If fixed API brokers are used, it is better to use FOK orders. If these are not possible, then market orders can be used. Finally, for investors with $10,000 to $1,000, we recommend locking arbitrage with two MT4 brokers. After some 4 weeks, latency arbitrage can be turned on if, for example, some news is about to come out. Do you want to know arbitrage trading secrets? Subscribe and get info immediately. Full name: